Well, shares in Alphabet and Tesla are tumbling. The first of the so-called Magnificent Seven to report earnings this season failed to impress investors. Revenues are rising, but so is spending, driven by massive investment in artificial intelligence. Now investors are asking whether the AI boom is delivering returns. Fiona Cincotta is an analyst at Citi Index. Fiona, great to have you on the show again. So we have seen that both of these companies have seen revenues above expectations and both stocks fell. So what does this suggest?
Yeah, so I mean, there's quite a lot going on here. I mean, if we look at Tesla, for example, share price down around 13%. We saw, a miss on profitability. We saw margins, so profit per car was also down considerably because they've been cutting prices, offering incentives. But as you mentioned, this idea of investment in sort of a pivot towards AI and robotics has been much bigger than expected, and that's what's really worrying investors. We saw something very similar with Alphabet. The share price has dropped around 6% despite really strong revenue, and adjusted earnings were above expectations, but the amount of capital expenditure which is going towards this AI infrastructure build out is enormous, and that's making investors very nervous.
Well, Fiona, we'll talk about Alphabet a bit later. So let's talk about Tesla first. So the company is expecting more than $25 billion in capital spending this year as it ramps up AI infrastructure and humanoid autonomy and also manufacturing. So do you think investors should be worried now?
I think, there is definitely a reason for caution. I mean, it's quite interesting because I think, Tesla has been talking about, robotics, autonomous driving for some time, but it does feel that investors are getting to this stage now actually where they're getting a bit impatient and they want to start to see significant returns on investments, and sooner rather than later. And I think it's this sort of time horizon that's getting investors a little bit nervous. That capital expenditure is up significantly from around 8 billion previously. So, that's why we're seeing is investors want to see the return proportional to the investment, and that's not happening just yet.
And Fiona, do you think that could trigger probably broader sell-off in the AI industry, in the AI trade?
We have the potential. I mean, I think there's been a lot of jitters with regard to the AI trade heading into these earnings because of the very sharp run-up that we've seen in sort of AI stocks. So we are seeing investors becoming a little bit more picky, should I say, in where they're putting their money in the AI trade. Obviously, next week we've also got sort of Meta, Microsoft, Amazon also reporting. So it's going to be very much in focus, but weak, or should I say strong spending numbers is going to potentially see further weakness in the share prices.
Well, thank you very much for your insight. That is Fiona Cincotta from Citi Index.